Welcome to The Explainer. Today, we're diving straight into the hidden machinery of global finance. We're not just looking at the surface level stuff you catch on the evening news. Oh no, we're going into the actual physical plumbing of the global financial system, the very mechanics that dictate the flow of money worldwide. So let's kick things off with a massive question. What actually happens when the Federal Reserve prints money? It's so easy for us to just focus on the surface, the digital balances and everyday transactions on our phones, but doing that completely misses the massive hidden levers constantly churning underneath the modern economy. To really understand these hidden levers, we're drawing directly on the insights of Joseph Wang. He's a former senior trader on the Fed's open market desk. His goal, and honestly our goal for this explainer today, is to lift the veil on this deeply mysterious world. Actually sitting on the trading desk that executes Fed policy, well, that strips away those outdated textbook theories really fast, and it allows us to reveal how money truly flows. Okay, let's dive right into this structural blueprint. We're going to peel back this complex machine in 5 layers. First, the hidden financial machinery. Second, 4 types of money. Third, the Fed's control panel. Fourth, the shadow banking realm. And finally, the truth about QE. Section 1, the hidden financial machinery. There's a really stark contrast between illusion and reality here. The illusion? That money is just that checking balance we use to buy groceries. But the reality is actually a highly complex plumbing system designed, maintained, and managed by a very small group of central bankers and technocrats. The money you and I interact with every day is literally just the very tip of an invisible iceberg. Section 2, 4 types of money. To really grasp the mechanics here, we have to completely shatter the idea that money is a single, uniform thing. It simply isn't. Now, we're all pretty used to physical cash and bank deposits, right? But look at the other two, central bank reserves and shadow money. The absolutely crucial thing to get here is that central banks do not interact directly with the general public. They operate exclusively in a closed wholesale market, using central bank reserves to settle transactions between massive commercial banks and the government. And honestly, understanding that wholesale market leads to a frankly shocking fact. Commercial banks create deposit money out of thin air when they make loans. When a bank approves you for a mortgage, they aren't going into a back vault and lending you someone else's hard-earned savings. No way. They are literally just typing new deposit numbers into existence in your account. That checking balance on your screen, it's basically just an IOU issued by your bank. Section 3, the Fed's control panel. So, zooming out to the very apex of the global monetary hierarchy, there's a fundamental difference in how these entities operate. Every financial institution follows the basic rule of balance sheets. Assets must equal liabilities plus equity. Commercial banks are profit-driven. They rely on strictly limited liquidity, and if they make too many bad loans, they face devastating bank runs. But central banks? They're public entities with a literal superpower. They have an unlimited ability to expand their balance sheets. When the Fed wants to buy $1 trillion in government bonds, it doesn't collect a single dime in taxes or borrow any funds. It simply creates an electronic accounting entry that credits fresh reserves into existence. Boom, just like that. Now, for decades, textbooks told us the Fed controlled interest rates by making these reserves artificially scarce. But after 2008, well, the system was flooded with so many reserves that the old textbook model basically died. To maintain control, the Fed had to build a brand new system using IORB, or interest on reserve balances. This is the interest rate the Fed pays directly to commercial banks on the reserves they hold at the central bank. By paying this rate, the Fed sets a rock-solid floor for short-term market rates. After all, no bank is going to lend money to another institution for less than they can get absolutely risk-free just by leaving it parked at the Fed. But wait, what about the massive institutions that aren't traditional commercial banks? Enter the Overnight Reverse Repo, or ONRRP for short. This is the Fed's brilliant workaround for bringing non-banks into the fold. This facility allows non-bank financial institutions, think giant money market funds, to lend their excess cash to the Fed overnight in exchange for treasury collateral and a guaranteed rate. By adjusting both the IORB for banks and the ONRRP for non-banks in tandem, the Fed smoothly steers short-term market interest rates up or down, totally regardless of how many trillions of reserves are sloshing around the system. Section 4, the shadow banking realm. So, moving away from traditional, well-lit commercial banks, we enter the vast, complex network of hedge funds, money market funds, and private equity. This shadow banking system involves huge non-bank institutions that handle trillions of dollars daily, but they don't take traditional retail deposits. And because they lack deposits, they rely incredibly heavily on the repo market, or repurchase agreements. Think of a repo as a highly secure, incredibly short-term loan backed by pristine collateral, usually U.S. Treasury bonds. This repo market is the literal beating heart of Wall Street. It's the central plumbing junction, providing vital overnight liquidity to these giant institutional players. And what exactly happens when that beating heart skips a beat? Just think about this number for a second. 10%. In September 2019, a sudden shortage of available reserves caused an absolute tremor in the system. Repo rates, which were quietly sitting around 2%, suddenly skyrocketed to nearly 10% in a matter of hours. This sudden spike threatened to completely freeze the entire global financial system. It forced the Federal Reserve to intervene urgently, injecting hundreds of billions of dollars straight into the repo market just to prevent a catastrophic failure. Section 5. The truth about QE. That kind of dramatic central bank intervention leads us perfectly into the deepest layer of the machine. Let's bust a major myth right now. The widespread belief is that quantitative easing is basically helicopters dumping pallets of physical cash onto Main Street, instantly causing hyperinflation. But the reality? QE is simply an electronic asset swap. When the central bank conducts QE, it buys a long-term government bond from a financial institution and simply credits that institution's commercial bank account with brand new central bank reserves. The total wealth of the institution doesn't change one bit in that exact moment. It simply traded a yield-bearing bond for a highly liquid short-term reserve balance. So, if it's really just an asset swap, how on earth does it actually stimulate the economy? Well, here is what you should definitely take away from this. That simple central bank accounting entry works its magic through 3 distinct channels. First, aggressively buying bonds lowers long-term borrowing costs, making things like home mortgages and corporate debt cheaper. Second, it drives what's called the portfolio balance effect. By hoarding safe government bonds, the Fed basically starves institutional investors of safe yield. This forces them out on the risk spectrum into stocks and real estate, inflating those asset prices. And third, it sends a powerful signaling effect, proving the central bank is fully committed to keeping financial conditions loose, which encourages businesses to borrow and spend. Of course, this machine works in reverse too. When inflation runs hot, central banks hit the brakes with quantitative tightening, or QT. This actively shrinks the central bank's balance sheet. By simply letting their existing bonds mature without replacing them, the Fed systematically drains reserves out of the banking system. This forces private markets to absorb a larger supply of government debt, which pushes yields up and tightens financial conditions everywhere. Now, you might be sitting there thinking this machinery is strictly an American phenomenon. But because the US dollar is the undisputed global reserve currency, the Fed effectively functions as the central bank to the entire world. A massive, massive portion of international trade, debt issuance, and commodity pricing is denominated entirely in US dollars. This has created an immense euro-dollar market, meaning US dollar deposits held in banks outside the United States. We're talking about foreign corporations and governments holding hundreds of trillions of dollars in these liabilities. Because of this massive global exposure, foreign banks absolutely need continuous dollar liquidity. I mean, if they suddenly run out of dollars to settle their daily trades, international credit markets can literally freeze up overnight. So, to prevent global meltdowns, the Fed acts as a global safety valve, using central bank liquidity swap lines. These swap lines provide temporary US dollars directly to foreign central banks, who then turn around and lend them to their local commercial banks. During the 2008 meltdown and the market panic of March 2020, the Fed expanded these exact swap lines to pump hundreds of billions of dollars into foreign markets just to stabilize the international financial architecture. All of this incredibly complex machinery brings us to one of the most famous adages on Wall Street: never fight the Fed. This is absolutely the core takeaway today. You can spend all day doing traditional corporate analysis, picking companies with fantastic earnings and growing market share, but it is practically useless if you ignore the overwhelming market force of central bank liquidity cycles. When the central bank is aggressively draining liquidity, valuations can collapse across the board. Conversely, when they pump liquidity into the system via QE, even mediocre assets can see absolutely dramatic price surges. So I'll leave you with this final provocative thought to really chew on. Are you still trying to fight the Fed, or are you ready to track the liquidity? You now have this deep, functional map of how money actually moves around the globe. Use this new understanding of the financial machinery to look past the noisy, everyday commentary, track the central bank actions directly, and navigate future economic cycles with total clarity and foresight. Thanks so much for joining me on this explainer, and keep digging into the hidden mechanics of our world.